All right, so I'm just going to work through this. If you have questions, interrupt me. But the first question is coming up with your discount rate. So for the discount rate for equities, you're going to do the risk-free rate plus beta times the market risk premium. Very, very famous formula in finance. The risk-free rate, she comes right in and says that she uses the 10-year treasury. So that's pretty simple. All throughout the exam, don't convert everything to decimals. Don't type 3.5, type 0.035. So anytime you see a decimal, 3.5 divide by 100, make it 0.035. I see students to get off a decimal place or actually use 3.5, which means 350%, not 3.5%. So that's going to be that plus beta times market risk premium. So we need to get expected return on stocks, which we know is going to be the dividend yield plus maybe buyback yield. We'll see if he uses that or not. Plus expected earnings growth. So when we put all those in there, we see that the dividend yield is 1.6%. You don't care what the dividend yield of the stock is because for the market risk premium, you only use stock market data. You don't use any individual company data. So the dividend yield is 0.016 plus, let's see if she does the buyback yield. And she does the buyback yield, which I actually like that idea as well. So we're going to add that in as additional yield on top of the dividend yield plus expected earnings growth. And she thinks earnings growth is going to be 5.5%. So that gives you an expected return on stocks of 2.6 plus 0.055. So that gives you expected return on stocks of 8.1%. And so in this case, since 8.1 is your expected return on stocks, then we know that the market risk premium is going to equal the expected return stocks minus the risk-free rate, which equals, in this case, the 8.1 minus 0.035. And so your market risk premium is 0.046. So we've got the risk-free rate and we got the market risk premium. So now we just need beta. Remember on beta is that 4-step process. So step 1 is your revenue sensitivity. And we can be pretty sure that Carmel is definitely a consumer staple and low beta stock. This is consumer staple, right? They sell food. It's a food processed meats, cheap, inexpensive food. People are going to buy this no matter how the economy is going. So consumer staple, so low beta stock. Operating leverage, how much fixed cost. So here, we don't really know, you might think they have a lot of property, plant, and equipment. But one indication we look at is, it's probably, you might put some editorial here, probably some PP&E and union workforce, but their net margin, standard deviation, that standard deviation is only 2.13%, ranking in the bottom 12.3% least volatile, suggesting low operating leverage and low beta. So it looks like a very, very stable firm, very predictable earnings. That implies a low beta. And then financial leverage, probably the easiest one of all. Here we look over at the table on debt to equity. Their debt to equity of 49.47% is in line with stock markets, 56.42%. Slightly lower, but not too far. And in history, the last one suggests a beta between, say, and this is somewhat subjective, say 0.2 and 0.8. A beta, and this again subjective, I'm going to say beta of 0.5 is consistent with all the above. So we'll use a beta of 0.5. We'll put our beta in here. And that gives us a discount rate 0.58 or 5.8%. And you want to double check that, just make sure, but 0.035 plus 0.5 times 0.046 should give you 5.8%. The second question, so I'll highlight what I've added to the answer. And I'll put this out there on Blackboard. So the second one, it says, okay, you got 5.8, ignore that. You want to use 6%. Now, if on question one, you got 15.7%, and I'm using 6% in the second question, you probably did something wrong in the first question. But if you got 5.8 on question one, and I'm using 6 on question two, you're probably pretty close. This question is really simple because it's just a matter of plugging numbers into formulas that you should know as finance majors. So dividend discount model, well, let's start with the cap earnings. Cap earnings model says the value of the firm is EPS 0 times 1 plus inflation divided by KE minus inflation. I have a really bad keyboard. KE minus inflation. Given discount model looks almost exactly the same. You can use the same formula as cap earnings, except instead of using earnings per share, read dividends. And instead of inflation, use long-term growth. Everything else is exactly the same. And then for the H model looks almost identical to the dividend discount model. And it is, except for, and be real careful with parentheses here. I've seen several students make math errors because they didn't realize this entire thing goes in the numerator. You have to add in dividend 0 times H times short-term growth minus long-term growth. Make sure that entire thing is in the numerator. So I have some students that'll do this, and then they'll do all of this, and that's not going to give you the right answer or even close. All right, so here we got EPS is $1.82 times 1 plus inflation. Inflation is 3%. Divided by, we're going to use a 6% discount rate, 0.606 divided by 0.03. And that's going to equal $62.49. In the dividend discount model, we're going to use dividends, which is $1.10 times 1 plus long-term growth. There's a long-term growth. It's given 0.05 divided by the discount rate 0.06 minus 0.05. That's going to equal 115.50. And then the H model, and we do dividend 0, 1.10, just like we did in the dividend discount model. The first part, 1.1 times 1 plus 0.05 plus, and then we're going to add that middle section, 110 times H. What's our H? Well, this paragraph here tells you that your short-term growth rate is 12%. And it's going to take 6 years. Remember, your H is half of that 6 years. So times 3 times our short-term growth rate, which is at 12%, minus our long-term, which is the 5%. All of that divided by 0.06 minus 0.05. And that should give you 138.60 if you want to check it. You take the second part of that formula, 1.10 times 3 times 0.12 minus 0.05 divided by 0.06 minus 0.05, you get 23.1. 23.1 plus what you got on dividend discount model, 115.50, should equal the H model, 138.60. It does. If you want to check it, you don't have to check it, but if you want to, you can. So there's the answer on that one. I'm going to take this off the top so we keep this on one page. All right. So there's question 2. Question 3. No, why question 3? Oh, there it is. Question 3. Well, let me do it. But question 3, we're going to do the bond. And so to do the bond, going to start off with the discount rate, KD, equals the risk-free rate plus the spread. Here it is a 10-year bond issued 8 years ago, so it is a 2-year bond. So the risk-free rate is a 2 years, so 4%, 4.3%, 0.043, plus our spread. So it's a 2-year bond, and it's rated A plus today. It used to be rated AA. We don't care about that. We only care what it's rated today. A plus, so that's 115. So remember the spread. It's 115 divided by 10,000, or 0.0115. So we're going to add 0.0115. We get that, we should get 0.0545 as our discount rate. The effective yield is going to equal 1 plus the discount rate divided by 2, raise it to 2 minus 1. And yes, you always use 2 because we're assuming the bonds pay twice a year. And so when you do that, the effective yield comes out to be 0.0552. Now I'm going to show you the math here, but there can be some rounding problems. If you're off by a penny or something, that's not a big deal. So I'm going to insert a pet table and just do this. So we need time, cash flow, discount factor, and discounted cash flow. So we need 4 columns, and we need 5 rows. So we'll start off on the top with time, cash flow, discount factor, and discounted cash flow. Time is going to be six months from now, which is 0.5, 1 year from now, a year and a half from now, and 2 years, because they pay every 6 months. Our cash flows, pretty straightforward. The coupon is going to equal the face times the coupon divided by 2, so $1,000. And here our coupon, it's a coupon of 6.5%, so 0.065 divided by 2. And so that tell you what the every 6 month coupon is. So that's going to be $32.50. So our cash flow, pretty straightforward, is $32.50, $32.50, $32.50, and then it matures $1,000 plus the $32.50. And then our discount factor is going to be 1 divided by 1 plus the effective yield raised the time. Make sure you practice this on your calculator over and over again, that you're getting the right numbers with the parentheses in the right place and the exponent key. So I'm going to show you the numbers I get. If you get different numbers, let me know, but hopefully it comes out correctly. It should be in this 0.9 range. So you raise it to the 0.5, do the same thing again, but raise it to the first, and to the 1.5, and then to the 2. And you know your factor is going to be 0.98, something like that, all the way down to 0.9 or so, depending on the interest rate. And so here our cash flows, discounted cash flows, you just multiply across 3250 times 0.9735, and that should get you 3164, 3080, 29.98, 927.23. So the value is going to equal the sum of the DCF. And that will equal 1,019.64 plus or minus a penny, depending on any rounding issues you might have. This is a question that's pretty basic. You did it in 3013, so it's something every finance major knows, but it doesn't hurt us to refresh. Just double check and make sure you're comfortable with it. I gave you a couple ways you can double check this. Some other formulas I gave you, but and you can actually double check it on your calculator, but make sure this entire table is on your exam. You get 0 credit if this table's not. I want you to see what your calculator is doing. If you do it in Excel, I mean, there's a function, it's the present value function. It works, it's really effective. And if you learn it in the calculator, you can essentially double check and make sure you have the right answer, but make sure you show this on the exam. I want just you mentally picturing what the calculator is doing. It's a real powerful skill to have. All right, let's jump to page number 4, unless someone has a question, you'll interrupt me. The number 4, we're going to calculate the holding period returns. And so to do that, we need each period's return. So what periods do we have? Well, we have November, October, and September. We can't do August because we don't have the beginning period. So remember, the holding period return is the ending market value minus beginning market value plus income, and all of that divided by beginning market value. So let's look at our income. We have a dividend of 26 cents, and all we care about is the X date. So that's in October. So when we do October, we're going to be adding 26 cents. But on the others, the ending market value for February is $47. Beginning market is $46.45. There's no income. You don't have to write that, but I put it just to make it clear. Divide that by 46.45, and you should get a return of 0.0118 for October. You have 46.45 as the ending market value minus 45.44 is beginning market value. And here we're going to have that 26-cent dividend, all of that divided by 45, 44. And that equals 0.0279. And then September, ending market value is 45.44. Beginning is 50.28. No income in this one. Divided by 50.28. And here they have a loss minus 0.0963. Notice how I do everything in decimals. So that gives me the first part is calculate the holding period returns. The arithmetic return, it's just going to be the average of them. So 0.0118 plus 0.0279 minus 0.0963 divided by 3. So that's going to equal minus 0.0188. Annualize, it's going to equal minus 0.0188. And remember, annualize arithmetic, you just multiply by 12. And that gives you minus 0.2259. You can put a little footnote there if you want to. We'll talk about that later. Then geometric average, a little bit more complicated, but you take 1 plus 0.0118. See how I'm doing the parentheses? Be real careful in the parentheses. 1 plus 0.0279. 1 minus 0.0963. So you link them all. Make sure you multiply all of that together and raise it to the 1 divided by 3. That whole thing minus 1. And you know you can get something that's going to be lower than the arithmetic. The 0.118 has to be lower than that, and I get minus 0.0204. Annualized. This is where you got to be careful on the exam. If I were you, I would do this part of the equation and write it down before you do the raise to the 1/3 power, because you're going to need that for the annualized, because all you do in annualize is the exact same thing. Except for instead of raising it to the 1/3, you're going to raise it to 12/3. And here you'll get minus 0.2193. Again, an asterisk. So there's my answers. So negative 0.0188 is my arithmetic. Negative 0.2259 is my annualized arithmetic. Minus 0.204. Geometric minus 0.2193 is my annualized geometric, and then the footnote is CFA Institute does not allow for annual periods that are less than 1 year. So I'm not allowed to annualize that because I only had 3 months. That's it. That's that question. Very straightforward question. Can't remember if that was our team competition or not, so we may be seeing some duplicate here. A very simple question, and you do this a lot in finance, so you should get used to calculating returns. All right, number 5. So Hormel is a consumer staple. It's somewhat retail. So price to earnings. What relative should we use for Hormel, consumer staple, and say this is okay ratio for all companies, though, is one better specifically for HRL. Enterprise value to sales, this is the best ratio HRL, a retailer focused margins. And look back on the notes on that, make sure you have the groups down. We talked about with tech and high growth companies, you want to use EV to EBITDA or EV to EBIT or PEG ratios. For heavy industry, a lot of property, plant, and equipment, price to book. For retail, you almost always do EV to sales. Anyone really focused on margins, you know Hormel is really focused on margins, the cost of the meat versus their prices. Enterprise value, the book value, the ratio is flawed because EV is stock and bond holders, while book value is only stockholders. You don't have to say much. I just want you to acknowledge that. And the enterprise value, the book value ratio is fine, but mainly used for tech companies focused on growth. So that's the final answer there. Make sure you talk about all of them. This isn't a multiple choice, or you just pick one. You gotta tell me which one you picked and why. And when you reject, there'll always be at least one that you completely reject, like here on enterprise value, the book value. That one you completely reject. All right, last question. The option question, this might be the one we did in class on the team question, I can't remember. But if so, we'll just practice it again. But calculate the call first. So here on the call, remember the value is going to be max of the stock minus the strike and 0 minus the call premium. That's going to equal max the stock price. If they're trading at $52 and the strike is 45, so we made $7 there. But the option cost $5.10. So $7 minus $5.10 gives us $1.90. Second question, exact same formula, except we do strike minus stock and 0 minus put premium. So here we do max of the strike is 46 and the stock price is 35 and 0. So there we're up $11. Oh wait, stock price is 45. I don't even know where I got the 35 from. Sorry. It's 45. It's trading at 45. So it made $1 there, but the option costs $2.15. So that means we had a loss of $1.15. You may actually, if you have a loss, you might actually write the word loss of. Sometimes with the negative signs, it's really hard for me to see the negative signs. Students don't write them very clearly, so you might actually use a loss of. All right, the next one's a protected put. Remember, a protected put is going to equal, it's going to be the stock plus a put. So the stock gain is the change in stock price. And then the put's going to be the max of the strike minus the stock, and 0 minus the put premium. So the change in the stock is the stock. Oh, there's the $35. It's trading at $35. The beginning stock price is up here, 48. So wow, we lost $13 on the stock, but fortunately we had the options, so we do the max of the strike 46 minus 35, so we're up $11 there. But we had to pay $2.15 to get it. So we lost $13 on the stock. We made $11 on the put. That's because our put was only $2 out of the money. So we lost $2. The put, we could have lost 13. We only lost 2 because the put protected us, but we paid $2.15 for the put. So we ended up with a loss of $4.15. And then the last one, the call option. So the option premium equals time value plus the intrinsic value. Intrinsic value is easy because we've been doing that formula so many times that it's just second nature. So intrinsic value just equals the max. Here we're talking about a call, so strike, stock minus the strike, and 0 minus the option premium. So that's going to equal the max. The stock, this is at time of purchase. The stock was $48. The strike is 45 and 0. So we're $3 in the money. Oh, I'm sorry. Did I say minus the option premium? Take that out. You don't do minus the option premium. That's the gain on the option. The intrinsic value is just a max of S minus X and, oh, sorry. Stock minus strike and 0. Sorry. So the gain, if you want to do the gain, you subtract the option premium. But here we're only doing the intrinsic value. The intrinsic value. So the gain on an option is the intrinsic value minus the option price. But the intrinsic value is just a max S minus X and comma 0. So that's going to equal 3. So the option premium on the call is 510. Equals the time value plus $3. So the time value equals $2.10. So that's it. Y'all have questions? Took me like 36 minutes, not even that, to work the whole thing. You got 2 hours and 15 minutes. I will put this out there on Blackboard with the answers. Should be a straightforward question exam. No reason not to get 100 on it. Let me look at the chat. So covered call, if we did a covered call, I don't have the number set up here, but if you did a covered call, you would do the stock gain is the same. You don't change that. So the stock gain would have been a loss of 13. And then you would have done max of stock minus strike, comma 0, minus the option premium, but use bid, not ask. And so that's going to be the call gain. But remember that the covered call, you are selling the call. So here that means the gain on the covered call is going to equal the stock, the change in stock price, and then minus the gain on call option. So you set it up, you do it just like you would do a regular call, except you use the bid instead of the ask. Get the gain on that call, but now since you shorted it, you're going to subtract that from the stock price. In this case, It's hard for me to do a covered call because my call is actually in the money, so it doesn't quite make sense. But if we did a covered call in this case, it's you would have 35 minus 48. And then minus this entire thing max. So the stock is 35 and the strike is 45. I'm a 0. So that's 0 as the stock price fell. Plus you got the bid 460. So essentially what it would be $13 loss on the stock, but you get to keep the $4.60 on the call option. So it would have been I guess 840 if I did the math right. All right, so if it was a call, oh, that's a loss, sorry.